Cashflow Pro offers free money management advice to help you take control of your finances. And now here's your host, personal finance enthusiast and licensed insurance broker, James Barber.
Good evening. Welcome to Oregon Cashflow Pro. My name is James Barber, here to help you maximize your cash flow. How's everybody doing tonight? This is our Wealth Care Wednesday live stream, here to help you care for your wealth. Got to take some time out of our day each week and spend a little time thinking about how we're maximizing our cash flow. What else can we do with our finances besides investing? Not necessarily other than investing. We can talk investing today, but really anything having to do with finances. So if you guys have questions, I'm here to try and help you out. So whatever we can do to provide some value. Brian Rashetsky, how you doing, man? Dominic, good evening. Good evening. I'm doing good. I'm doing good today. I must have got some sleep last night because I'm not too tired. It's the end of the day. I'm sure my voice is going to go after a little while because I've been talking all day since our first live stream this morning and then meetings all day. But I haven't had any energy drink today, and I'm still feeling pretty energized. So things are going good. It must help to have a nice up day in the market. Seeing Tesla do so well does good things for my good things for my outlook here. About to cook some cheeseburgers. You don't know how healthy you're starting this out. All right, cheeseburgers can be good. I don't eat too many cheeseburgers these days. Not ever since the pandemic started. I used to eat a lot. Used to have them a lot. You got a big smile from all the green. Yeah, it was a nice day. Nice day. Looks like Tesla sold a little tiny bit. Not as much as I expected. I actually thought that there would be a sell the news action after hours, but it seems people are waiting to hear first quarter deliveries. So we'll probably start to hear some of that. I imagine in the morning. Probably start to hear about first quarter deliveries. So tomorrow could be interesting. My expectation is deliveries will be lower than expected. Not by much. I mean, depends on what your expectations are. But it'll be much better than last year's first quarter, but lower than fourth quarter of last year. So quarter over quarter will be a drop, which is typical. It always goes down. But I think that'll probably lead to a sell the news, because people that are just waiting to hit that sell button, people that were part of the buying in today, are probably going to try and sell tomorrow. That's my expectation. We'll see. We'll see. Dominic, you have a question about Ethereum and my thoughts on crypto. You've been seeing a lot of people go big in Ethereum right now. Do you think it will be significantly going up? That's a good question. I'm not a big crypto guy. I do pay attention, though. And we do have some folks in our Discord who are pretty big crypto guys. And Ethereum is on their list of things that they're bullish about. So one of the guys in there, Harry Bowman, he's very bullish on Ethereum. He thinks Ethereum will ultimately, while it'll have a better return than Bitcoin from here this year, and I think he likes Ethereum in the long run as well. Obviously, Ethereum has some challenges going on with the what do they call it? With those fees. I forget what they call those fees. But anyways, Ethereum, though, very popular. A lot of more talk about it since it's being used for transactions on all the NFTs. So a lot of good reasons to be bullish on Ethereum. I don't own any crypto at the moment. Problem is, crypto, I can watch it all the time. There's no off days. Gas fees. Thank you. Gas fees. The problem with crypto is you can trade it 24/7. And so for me, I have a really hard time buying and holding. If I see something that goes up and I think it might come down, I like to sell it. So I do. And so I have a hard time hanging on to those. So I buy in every once in a while and then I sell it when it goes up. Definitely not the preferred method if you want to try and make some money in those things. But I just hop in every once in a while when the market's closed and hop out when it goes up. So probably not the best person to talk to about that. Yeah, gas fees. Yep. Gene, good evening. You recently got a few Ethereum. Nice. Nice. Brian says, all this NFT talk and all the Ethereum talk about Ethereum 2.0. They say Ethereum 2.0 will be like Crypto 2.0. We'll have no gas fees. Oh, that'll be good. That'll be good. I'm not sure what the gas fees do, though. Is that something that people get for doing the transactions? And if so, how are they going to authenticate the transactions otherwise? Isn't that what the gas fees are? I don't really know. Like I said, I don't pay too much attention to the crypto arena. Although, I do have some pretty cool shirts at my Teespring store, which you can see in the link. And it stemmed from my frustration with hopping in and out of crypto. And the theme of the shirts is called Stupid Crypto. But it's not a bad thing it doesn't say anything bad about crypto. It's just like a frustration remark, but it has some Bitcoin on it. I'll take a look at it. Let me know what you think. A few people have bought them. Brian, you don't know about that part. You don't see why fees are involved in software, but you don't know. But yeah, somehow they say gas fees will go down. Well, usually the fees, in my understanding, the fee is to authenticate the transaction. You got to have some type of incentive for the network to authenticate each transaction. And like Bitcoin, it just uses a whole bunch of energy and it authenticates by authenticating the whole entire blockchain. And so the longer Bitcoin's around, the longer that blockchain's going to be and the more energy it's going to take to authenticate it after every transaction. I think Ethereum was kind of solving that problem by using a different method of authentication so that you just have random groups of people that would do the authenticating. But that might be a different crypto. It might not even be Ethereum that I'm thinking about there. Like I said, that's not my area of expertise. But there are different approaches besides the way that Bitcoin does it. Ways that authenticate quicker and use a lot less electricity. So it could be good for long term. Especially if you're going to use something that is involved in a lot of transactions. Sounds good. All right. Well, anybody have any questions about, let's see, we talk about life insurance, infinite banking, dynamic banking, lines of credit, home equity lines of credit, business lines of credit, credit cards, credit card rewards. What are you guys doing out there to maximize your cash flow? I want to hear about it. I want to hear what you guys are putting into practice. What kind of success are you having maximizing your cash flow? Thoughts on weed stocks? I think I'm hopeful that we're in the early stages still where they're going to actually turn into something and they've got room to grow. Hopefully we'll see some federal legislation legalizing cannabis. It's been legal here in Oregon for years now, and I think it's a good idea. So I'm anxious to see it legalized nationwide. It's not something that I do. I don't partake in it personally, but I know people who benefit from it. I know people who benefit from using it medically. And I don't know anybody that's been harmed by it. So, I think it's less impactful than alcohol. Less impactful than cigarettes as far as health goes and society. So I'm interested in seeing that legalized, and that should help. I'm also interested in seeing the people released from prison that have been jailed because of it. Get that off of our books. We don't need to be paying all that money to lock up people for smoking a plant. Brian, you've been more of a saver, so that's a good question. Which part's a good question? Anyways, as far as the weed stocks, I do own Tilray. I think that's the only one I own right now. I haven't really dabbled with any other ones. They all hit big a little while ago, and then they kind of went back down. Oh, the amount of people that you know alcohol is destroyed. Yeah. How to maximize your cash flow. Oh, okay. Yeah, I'm all about helping people maximize their cash flow. So I would highly recommend that you guys watch, if you haven't yet, search my dynamic banking videos. The first one is Beat the Bank. Beat the Bank. Beat the Bank is the introduction to dynamic banking. And then dynamic banking in action, I go through exactly how it works. And it's not magic. It's just one way that I think everybody could take advantage of all the money that flows through their hands. Business owners especially. Business owners especially. Chris Birch, how you doing? Oh, I didn't respond to your email. I'm happy to meet up. I'm happy to have an interview on your channel. Happy to have an interview on your channel. I saw you have a growing channel. I'm going to be doing an interview with Brian on his growing channel. So anything I can do to help you guys out, certainly. Just go to my Calendly. I'm going to post my Calendly link here in the comments, and just reserve a spot on my schedule. If you just reserve a spot on my schedule and in the description tell me what we're going to be talking about, I'll be ready for it. There it goes. So there's the link to my Calendly. So Chris asks, how's COVID affected my business, insurance, stocks, etc.? COVID, it's affected me. I mean, we've basically been in a lockdown since last March. And at that point, I decided I'm focusing. I mean, I had already started focusing on just doing my YouTube channel and selling insurance with people that contact me through my YouTube channel. And as soon as we got into lockdown, I basically focused on making more videos. And as soon as I started making more videos, my business took off. So I don't know that had to do with COVID, although I think it probably had an effect because there was probably more people searching for life insurance. I know there's more people searching for life insurance after COVID, and more people just having more spare time to sit in front of YouTube and watch whatever gets recommended to them. So that, coupled with my putting out a lot more videos about it, definitely led to an increase in business for me. And so now I'm busy all the time. So when COVID first hit, I was probably doing 1 or 2 meetings a week with folks that would sign up on my Calendly. And now I'm doing like 6 a day. And I had to like limit it. Otherwise, I would probably do like 10 a day if I didn't limit it. If I didn't cut down on how many meetings are available. So it was pretty good for me. It was good for me. I wasn't affected personally by COVID. I haven't contracted it. My wife, none of my kids have contracted it, so we got lucky. We've been able to avoid it. One of my good friends in Portland came down with it early on, and it hit her hard, very hard, and the effects lasted for months. It was really bad. So we were very cautious. We were very cautious after that. And since then, we've had a couple of family members get it. One of them has had it and had basically no symptoms. Didn't really affect him at all. Another one, it did affect him, and they end up in the hospital as well. So it's definitely had an impact, but nothing too close. Nobody I personally know has passed away from it, thankfully. Although I may be just not realize it if I've known people. I'm sure there's people I've known that I know who have passed away by it. But with all the lockdowns and stuff, I just don't interact with a whole lot of people these days, other than the folks on my channel. So, Brian asks, a good place to put your money that's better than a bank but safer than stocks. That's what I deal with all day long. That's my cash value life insurance. You should definitely check out my videos on that. We've got different choices. Whole life insurance and IULs are my specialty. And as long as they're designed properly, it's a great place to store your money. You have access to it right away in year one, the vast majority of it. So it's very liquid, and it gives you a place for it to grow. And it's not correlated with the stock market. Or it has protection from the downsides in the stock market. A lot of good opportunity there. So we can talk about that maybe on during our interview, if you got some questions along those lines. But yeah, you definitely got to be checking out my other videos. Infinite Banking, it's wild. Infinite Banking. Go check that out. I mostly deal with it in regards to whole life insurance, but it can be done with IULs as well. And what I recommend will vary depending on your situation. We tend to use them for different reasons. So like whole life insurance is great as the base of our wealth pyramid. I would recommend checking out my wealth pyramid. I have a video on my wealth pyramid. And the base of the wealth pyramid is the key to a solid foundation so that you can basically handle any storms that you come across. It's not going to topple over. If we have a strong base of a pyramid, nothing's going to topple that thing over. It's not going to move. And so that's the idea behind the wealth pyramid, is we want to make sure that we have a strong financial base. Whole life insurance, insurance in general, makes up a big part of that base. And whole life insurance can help serve as a good part of that. IULs can as well, but when it comes to getting a death benefit, which I think most people have a need for at least some death benefit, whole life insurance is a great way to meet that death benefit. Now, for young folks, you may not need to go whole life. You might be able to get the death benefit that you need early on with an IUL and have some good growth opportunity, better growth opportunity than with the whole life. You just get less guarantees. So, different approaches. But usually just take into consideration what your needs are, what your wants are, what are your goals, and which one of the products can better complement whatever the rest of your investing portfolio entails. So, yeah, definitely check those out. A lot of good information that I have out there. I mean, I have like 200, I think I have 200 videos out there now on all of that stuff. And then I've got another 400 live videos where we do all the day trading and talking Tesla and Wealth Care Wednesdays. I talk about all different kinds of stuff on Wealth Care Wednesdays. And then I cut it into little pieces, the stuff I talk about on Wealth Care Wednesdays, and I make smaller videos with that. So I actually have somebody that's helping me with that right now, which is how I'm able to keep up with all these live streams and still get some videos out on the weekend. Chris, you set up a Calendly for April 14th. All right. I'll be there. I will be there. So, let's see. Gene, you have 7 high cash value whole life policies in place already. Should you get an IUL? Wow, I didn't realize you had 7. Did I? Did I know you had 7 already? I've been talking with so many people. I kind of lose track. That's awesome. An IUL can be good. It can be good if you have enough death benefit. So a whole life policy is awesome. It's great. It serves a need. Okay, you didn't tell me. Thank you. Whole life is great for meeting your basic financial needs. A great tool for storing cash in a place that gets you guaranteed growth. But it's not going it's not going to give you a place where you have a whole lot of growth potential on top of that. So I do like for me personally, I like meeting my basic death benefit needs and a large portion of my income. I flow through my whole life policies. But after that, I want something more like a retirement account. And that's what I treat the IUL as. I like the IUL as more like a retirement account, but I can still do all the same things that I do with whole life. It's got a little bit better loan opportunities, better arbitrage opportunities, better growth opportunities, but the growth is tied to an index. So it is tied to something in the stock market. That's where we get the better growth potential. But we don't get those guarantees. We don't get that 4% guarantee. What we do get is we get a guarantee against the downside in the market. So if the stock market goes down or the index goes down, we have a 0% floor. So we're not going to take losses if the market goes down. The nice thing about that is, depending on what your investment needs are or what your goals are outside of that, but it's a way to basically be a little more aggressive in a safe product. You can be more aggressive in a safe product. And the underlying cost of insurance is less expensive than the whole life, at least in the early years. And we try and design it to minimize the costs in the later years by reducing that death benefit in the later years. So it's not a tool to meet a death benefit down the road, at least not above and beyond what you can save. All of the cash value in your policy is always going to be available as the death benefit. But then there's also an additional part that you pay for. That's that underlying cost of insurance. And that's what we try and minimize so that we can get maximum advantage of the growth potential in those policies. So I love them for what they have to offer, and I have both. You have a lot of death benefits with your whole life policies. Will you be limited by your current death benefits? You could be. Yeah, you absolutely could be. So when it comes to qualifying for insurance, you do need to be able to financially qualify. And one of the limitations on what you can qualify is how much death benefit. And you get a certain amount of death benefit that you can qualify for among all of your policies. And that's often limited to a certain percentage of your income. That's usually the way we get the biggest death benefit, is we take your current income and then we have a multiple. And that multiplier might be 70 minus your age. So if you're 50 years old, you can get 20 times your income for a death benefit. 40 years old, 30 times your income. Some places it'll just be 30 times max. So even if you're 20 years old, it's still going to be 30 times. The good news is that even if you're maxed out, you can get insurance on other people. So your spouse can often qualify for the same amount of insurance that you have. Now that depends, because as you get older, if you get closer to retirement or you retire, you're going to qualify for less death benefit. Even if you have death benefit, your spouse is probably not going to be able to qualify for the same amount. But we can always try. We can always try and see what kind of death benefit they'll qualify you for, or them for. You can get insurance on your kids. You can get insurance on business partners. You can get insurance on your parents or your grandparents. So a lot of these things are variable. It's going to depend on what type of insurability we can quantify. So you have to have an insurable interest, and that's often the challenge. So trying to get insurable interest in other people, we end up with some limitations that often makes it so that it's hard for us to get the death benefit that we need in order to contribute a lot to it. So yeah, I mean, we can always get together and talk about it. Certainly wouldn't take it off the table without having a discussion. But if it's something you're interested in, an IUL can be a great supplement to a stock portfolio. So your stock portfolio, 100% at risk in the market. Obviously, you got all the upside, but all the downside as well. As opposed to a part of your portfolio, if a part of your portfolio is dedicated to maybe something conservative, that is a lot less risky and at the same time limits the growth potential, that might be something that's good to replace with the IUL. The IUL gets us that downside protection. So we get that conservative savings part where you're not going to lose money, but it has all of the upside potential. Sometimes these things can grow at 5, 10, 15, 20% a year. And you still have all that downside protection. So imagine, instead of using a conservative part of your portfolio in like a money market account that's earning you 1% interest a year, you put that same amount of money into a policy instead and potentially earn 5, 10, 15% a year. And you got that downside protection still. Market goes down, you don't go negative. You got a 0% floor. It can be a really nice tool. You'll get deeper into this during our meeting next week. Okay, cool. Look forward to it. What else are you guys doing out there? Hey, Gene, tell me about what you're doing with your whole life policies. You've got 7 of them, so I assume that you're doing some kind of infinite banking with them. But are you using it for other investment opportunities, or are you just waiting for some other investment opportunities? CDG, how you doing? You've seen some advocate taking home equity. Oh, you've seen some advocate taking home equity, putting it in life insurance, whole life or IUL. You've heard that some life companies don't like that. Thoughts? Yeah, I mean, basically, if you're planning on doing that, there's no reason your life insurance company would have to know about it. But yeah, the life insurance companies in general, they like to see your premiums come from income or savings. Now me, I consider the equity in my home as part of my savings. So I don't tell my insurance company if I'm funding my insurance with a home equity line of credit. But that's what I did. I don't have a home equity line of credit right now because I refinanced. But that's what I did when I had my home equity line of credit. And I think it's a great use of funds. Oftentimes, your home equity line of credit can be a very low interest rate, possibly lower than what you could earn inside your policy. But you're basically you're using that equity to create a place where you're going to grow some wealth, and you're going to get compounding growth that happens for the rest of your life as soon as you get that started. And you can always take that value that's in your policy growing and pay off the home equity line of credit. So it's a very low risk way of approaching it as well. John Tran, how are you doing? You've been asking some good questions on my videos. Why does it matter to them, the insurance company? So it matters to them because I think your traditional designed whole life policies and IULs are kind of not really great products. The whole life especially. Like a typical whole life design, if I design it for all base premium, it's all whole life insurance, there's no blend, you're not going to have any cash value in the first couple of years. So what happens if you take out a home equity line of credit, you fund your whole life policy and have no access to that cash value, and then the housing market crashes, your bank doesn't let you borrow from your home equity line of credit anymore, you maybe lose your job because the economy is tanking, and now you have no way to pay back the home equity line of credit, you have no way to make your whole life insurance policy payments, and you have no access to the cash that you put into the policy. That's a recipe for disaster. And not that whole thing happens all the time, but people do get in trouble when they commit to too high of premiums in life insurance policies that are not liquid. So these terribly designed policies, people commit to paying too much, they stumble financially, and now that policy is a burden. And so they end up lapsing. The policy ends up lapsing. And insurance companies see this all the time. So they're used to encountering poorly designed policies that often lapse. So they have to be very tight in their underwriting. They're very tight in their financial underwriting. And they don't want people to get out over their skis. They don't want people committing to too much premium. Because they see it all the time where they just let policies lapse. Sometimes they just get tired of paying for them because they're not seeing the benefit from it. They keep putting money in and there's no cash value that comes out of it. I encounter people all the time, and it's frustrating to those folks to know that they're putting all this money out there and they were told how great this thing could be, but it's not great. And that basically comes down to how it was designed. Like these policies that I design and sell, people have 90% cash value in the first year, 87% cash value in the first year. It totally changes the conversation if people have access to that cash value and suddenly they stumble financially. Now it's not a burden. Now it's a product that can help save them. It can help them meet whatever their financial needs are. And everything just works better when it's designed for it. So I don't know why I don't know why insurance companies continually make it so that people can design such horrible policies. I mean, I think it's just because they make money either way. People end up giving them thousands of dollars and then their policies just go away. So I think that some of them just value that more than just having more happy customers. That's the only thing I can think of. And I know that there's agents out there that don't like to cut their commission down. You know, part of the design that I'm doing really minimizes the agent commission, typically by like 10 times less. So it can really substantially lower it. And the way life insurance is traditionally done, it might be hard for someone to make a living if they're not making that much commission. It works out fine for me because I don't do any marketing. I just do YouTube and I meet with people via Zoom. My costs are very, very low. I don't go door to door. I don't buy leads. Oftentimes insurance agents will buy leads in order to get clients, or they'll make cold calls all day long. They basically spend a lot of effort and time and often money trying to get in front of more people. And so they have to have a higher commission. I don't need to have that. And so I don't have to worry about designing the best policies for people. So, but yeah, I think it comes down to just the insurance companies. Their financial underwriting has to take into account that people are getting really poorly designed policies as far as their cash value or their cash flow is concerned. CDG, okay, you didn't know whether you really have to disclose where the premium was coming from or not. I mean, they have questions, but they're going to ask you where the premium's coming from. The premium's most often coming from cash and savings. You know, I mean, if your client fills out the application, if they know that they're going to be pulling money from a home equity line of credit, I don't necessarily see that as having to answer yes to any of the insurance company's questions. So the insurance company asks you, are you going to be borrowing money for paying the premiums, right? And mostly that question is to meet premium financing. It has to do with premium financing. and that's not what we're doing. If somebody wants to borrow from their home equity line of credit, well, the way I treat a home equity line of credit, that's where I put all of my savings. So I don't view that as borrowing from somebody to pay the premiums. I view that as taking from my savings to pay the premium, because that's where I keep my savings. When I had my home equity line of credit, I kept my savings in the home equity line of credit, waiting to deploy it. Money in your home equity line of credit, if you're going to go out and you're going to invest, it's considered seasoned funds. The money in your life insurance policy is considered seasoned funds. There's not a whole lot of difference there. So I don't really worry too much about that as far as if somebody's pulling it from a home equity line of credit and they answer that question as no, they're not borrowing to pay it. Now, if they're going out and just getting a loan in order to fund their life insurance policy, yeah, maybe they need to be answering that question a bit differently. You definitely want to be as honest as you can be when you're answering the questions in the life insurance application. But there's a 2-year contestability period. If they haven't contested any of what you've answered in the first 2 years, it stands. The contract's going to be in place. I know an agent, a buddy of mine, who I first started working with this. Guy smokes like a chimney. And he said in his application, he's not a smoker. Apparently, he didn't have to go through and do a blood test or anything that revealed he was a smoker. But he went over 2 years. Didn't end up being an issue. Now, if he got caught by the insurance company, he'd probably lose his insurance license for doing that. But the only way that that's going to be a thing is if he dies. And they find out that he died, and he had cancer or something, lung cancer from smoking cigarettes. And then they realize that he lied on his application. But it's past the contestability period, and he doesn't need his license anymore because he's dead. So he figured it worth the risk for him. So, anyways, just an interesting story. Gene, you're using your infinite banking with your stock investments. Nice. You got a lot of cash value available, about $200,000 to use to maximize your cash, but don't know how to do it for your business and personal finances. You also use the policies to buy your company vehicles. Oh, that's awesome. That's awesome. I love to hear success stories like that. I look forward to our conversation. Yeah, definitely be able to help you figure out a way to maximize that cash flow for your business and personal finances. So that'll definitely have to be a little deeper conversation. But if you haven't seen my dynamic banking videos, I would start by watching those, because we're definitely going to be talking about dynamic banking and figuring out how to make that work for you. Now, dynamic banking involves the use of lines of credit, but it doesn't have to involve the use of lines of credit. Our life insurance policies, when we take loans from those act just like lines of credit. Okay? So there are ways that we can utilize our policies like the lines of credit. I just prefer to also have a line of credit in addition to that. Personal and business. Personal and business. So, David, how are you doing? Market was finally green for the good stocks. I know it. It was a great day. Great day today. Gene, you have lines of credit as well. Awesome. That's why you're confused. Uh-oh. I'll help you straighten it out. I'll definitely help you straighten that out. Once you get a handle on this and you start getting used to how your money flows and doing it to maximize that cash flow, it gets easy. It actually gets pretty easy. But it's just figuring out how to do it and then getting used to doing it. That's where the challenge comes in, I find. So, David, instead of stocks that need help like airlines and such. Yeah, no kidding. CDG, you've wondered whether all this accelerated underwriting, non-med underwriting is actually more risky for the companies. Thinking about my smoking agent friend. Oh, it's definitely more risky. Non-med underwriting is absolutely more risky, and that's why they charge more for it. You do get a higher cost in your policy if you do a non-med underwriting. Accelerated underwriting, that one's questionable. I mean, it can be a little more risky, but they still do quite a bit of in-depth searching. Like, they'll go through medical records. They might miss a thing or two, so it does add a little bit of a level risk. But they've got so much data these days, it's probably not going to make a big difference. So I'm not too concerned about that. But the non-med underwriting, they do charge more for that. So I imagine they're accounting for it. Doesn't mean there isn't going to be companies that get in trouble, though. There are probably going to be some companies that get in trouble for being too aggressive in what they'll allow. David, thank you, my friend. I appreciate that. Let's go Tesla. And GRWG. What's GRWG? Tell me what that is. I recognize it. I recognize the ticker. But I can't think of what it is. Gene, thank you. Appreciate that too, my friend. Can't wait to meet and talk about it. I feel the same way. Jones says, is there a quick answer to how you use infinite banking with stock investing? I actually just put a video out on that last week. Check out that video. It's not a very, I think it's like a 4-minute video. Fairly quick. But, to give you another quick answer here, I would say you have cash value that you're building up inside your infinite bank, and you have access to that cash value at a certain percentage interest rate. It varies depending on the company. So you've got to decide if you want to borrow from the insurance company at 5 or 6% interest, or whatever the interest rate is, and put that in the stock market. You want to have a plan that you're going to earn higher than that in the stock market. And you'll be able to fund, you'll be able to pay that interest off. Because we want the growth in the market to compound, but we don't want the interest that we're paying in our policy to compound. So we also want our policy to compound. So if our policy is compounding, the cash value in our policy is compounding, we don't want the interest in our policy compounding, and then we also want to get growth in the stock market. Now, for me, there are strategies that we can do that is very safe. Let's call it very safe way to invest and still get a really good return in the stock market. Really good potential return. Okay? I love using options. I love using options in there. Covered calls, utilizing covered calls, along with some stocks in some solid companies that you believe in, is a great way to use, in my opinion. This is what I do. This is a great way to utilize money from your infinite bank, invest it in the market, and get a return that's substantially higher than the interest you're going to pay in your infinite bank. So, it's not just with stock investing, but when we look at utilizing our infinite bank to do investing, we always want to use that. We want to use the ability for it to pay back that loan from your infinite bank and still get a return above that. We want to use that as the benchmark. So what I often think of is, by going with our infinite bank first, if we're using a whole life policy, let's say, we've got guaranteed growth, might get 4% guaranteed growth, maybe a little bit higher after dividends. Those are gross numbers. So after all of our expenses and everything, we're probably going to see 3 to 5% growth inside of our infinite banking policy. Okay, so that gives us a really good tool for saving money and holding money until we deploy it to invest. But it also raises the bar, because we're not going to take money out of there that's earning a guaranteed 3 to 5% interest rate. We're not going to take money out of that product and put it into an investment that is going to earn us less than that, or maybe even just slightly more than that. Like, we have no risk basically in that policy, and we're not going to take that out and try and earn 6%, but have it be 100% at risk. It doesn't really make sense. So we kind of get an upgrade. We get to upgrade our investment opportunities when we weigh it against that. And we get to turn down the things that it really doesn't make a whole lot of sense to do an investment for if we have to add in that risk. Not to mention, this is tax-free in our policy. It's tax deferred, but when we access it, we're going to access it tax-free. So you take a 3 to 5% interest rate, you make it tax-free. Now the equivalent of that in a taxable investment is going to be something like 5 to 7% probably. Maybe 4 to 7%. So now you really got to up your game. People that want you to invest in their things, they've got to really up their game and promise you a better rate of return. Ben asks, can I explain how they do the crediting on a daily, monthly basis for IUL policies? Yes. So they basically don't. You don't get credited on a daily or monthly basis for IULs. You get credited based on your point-to-points. Now, depending on what index options you're using, it could be an annual point-to-point, in which case you're going to get credited once per year. It could be biannual, so where it's a 2-year point-to-point, in which case you're going to get credited every 2 years. It might be monthly, but you're still probably only going to get credited once a year, even though the your point-to-points are going to happen monthly. Now, you could end up with a situation where you're funding it a little bit each month, and you'll end up with 12 different point-to-points, even if, let's say, 12 different annual point-to-points. In that case, you're going to end up getting credited each one of those points as they expire each year. So what will happen is they'll take, let's say your January point-to-point. They'll take January from 2020, and they'll go January to 2021. What was the growth in the index? How much do you have in that particular period? And that'll be configured for your growth, and that'll be the credit you get that month. And then they'll go February. And if you had a February to February, then they'll do the figuring on how much growth happened in the index for that point to point, and then you'll get the credit then. So that's how it works out. You don't get, I don't know of any of them that give you credit on a daily basis. Now, it might be possible that you can get close to daily credits, unlike an Allianz, where they put money into the market any day that it gets into your policy. But I haven't had my policy long enough to figure that out. So that'll be interesting to find out. There's other companies that have like 1 point each month where they put money into the market. And so like National Life, the 21st of every month. So if you send them money once a month, you're going to get a annual point-to-point that starts on the 21st of each month and goes to the 21st of the next year, that same month. But Allianz, when they get the money in, they'll put that money in the very next day that the market's open. So might end up with many point-to-point periods with an Allianz policy. It'll be interesting to see how that develops. I have a couple of Allianz policies. My favorite IUL carrier at the moment. But I haven't had it for more than a year yet. Anthony Thomas asks, says, evening, can insurance policy be put on credit cards? Actually, it can. Sort of. So, apparently there's some companies out there that will accept a credit card payment for a life insurance policy. Most of them will not. Most of them want cash or a check or the automatic withdrawal. But you can use a company or a website, plastic.com. Excuse me, that's PLASTIQ.com. And you can use your credit card, and they will turn that into a check and mail it to your insurance company. And so you can pay your insurance policy that way. You need to have an invoice. So it would be at your policy anniversary, you could do that. Or what I've personally done is I've gotten a 0% credit card interest special offer. And with that special offer, I used plastic, and I paid back some of my loans in my policies with it. So I used that to pay back a loan, and then I just borrowed it back out again. So I was able to access the cash value off of my credit card at 0%. And using plastic, it cost me like 1.9% or 2.9%. So ultimately, it cost me 3% at most to get the cash off of that into my policy as paying back the loan. Although I think I did one as new premiums as well. And then I was able to get the cash back out. And now I used it to invest in the market. So, because of course I can do a lot better investing in the market than leaving the money in my policies. So yeah, you can do insurance policies on a credit card, even if the insurance carrier does not accept credit cards directly, which, like I said, most of them do not. David, okay, it's Grow Generation Cannabis stock. Gotcha. I knew it looked familiar. Is it doing well? I know Tilray was up today. I think most of your marijuana stocks were up today, except SNDL. SNDL was down just a little bit. Went up in the aftermarket, it looks like. Just a little bit. I actually cleared out my position. I was meaning to tell people that in my live stream this morning. I sold my SNDL position. I had 7,500 shares, and I was up, I don't know, 40%, 50%. But I'd also sold a bunch of covered calls against it and made money on it. So ultimately, I probably made well over 100% on those 7,500 shares that I bought. So it seemed like it was a good time to get out of it and start focusing on some other efforts, because I'm not too thrilled with the return on the covered calls with where it's been sitting at. It was kind of like right in between $1 and $1.50 for a long time, which makes it really challenging to do week to week selling covered calls. It needs to either be close to $1.50 or close to $1 in order to make it worthwhile. So, or just under $1. Somewhere near the price of that. When it's that low of a priced stock, it doesn't work very well when it's in between those numbers. So I ended up getting out of it. So just so you folks know, I'm out of my SNDL position. Not because I don't like the stock. I think it still has some potential there. But at the price it was at, it didn't make a whole lot of sense compared to some other things I can do. You're welcome, Anthony. You're welcome. Ben, did that answer your question well on the crediting? We've got about 7 more minutes on this live stream. I like to go for at least an hour so you guys can get your questions in. But if there's no more questions, we may just call it a night. I know Godzilla and King Kong was released, and I'm planning on watching that tonight before I fall asleep. So, I think it came out on HBO Max today. And then we got an exciting day ahead tomorrow. We've got first quarter deliveries for Tesla. Should be announced either in the morning or sometime in the day. It might leak out. I expect it'll probably come out in the morning. John, if you buy an IUL for your kids that are in their early 20s, do they have to go through a health exam? Sometimes they do, sometimes they don't. One thing to keep in mind is that if they're in their early 20s, are they still living at home? Are they still considered a dependent for you? If they are, then you can buy their IUL. If they're not, most insurance companies would like adult kids to own their own policies. Well, they like adults to own their own policies, even if it's a kid. If they have their own job, even more so. But if they don't, if they're still a dependent, say they're going to school, then yeah, you can still own their policies, you can pay for their policies, and there's still that enough insurable interest. So it can be a good idea. And for the most part, most carriers these days are trying to do accelerated underwriting, where they will get the information they need to make a health rating determination based on the health questionnaire that they answer and their medical records. So kids in their early 20s likely have plenty of medical records. Unless you're asking for an enormous amount of death benefit, they probably won't have to go through a health exam. Scott, how are you doing, man? Thanks for the 50K illustration I sent. Quick question. When will the new tax law start? Would it impact your new policy? Good question. So there was a new tax law. It changed the 7702 rules, and it will not affect your new policy. So the changes don't go in effect until next year, although carriers will be coming out with some new products based on those rules at some point this year. Most of them are going to come out with products later in the fourth quarter, probably. I know Allianz isn't planning on until late in the fourth quarter, maybe beginning of the next year, when it's the absolute latest. I haven't heard anything from Guardian, Mass Mutual, or Penn Mutual as far as when they're going to come out with some new products. Prior to new products coming out, no effect. You can still get your policy and be under the old rules. There are some carriers, though, that have already instituted the new rules. I think Nationwide and Pacific Life. I think those are two that have already instituted them. Hang on a second. I saved the picture at the webinar I was in that told me which carriers. It was Symetra and Nationwide. Symetra and Nationwide. Symetra implemented the changes mid-February of this year, and Nationwide announced on March 1st their intent to have the changes effective April 12th. So, pretty interesting. So I'm going to have to check out Nationwide. I'm not contracted with them yet. I can be. I know I've seen some decent designs from them. But for the most part, I've seen a lot of massive, massive surrender charges with that company. So I'm going to look and see about getting contracted with Nationwide just so I can see what these 7702 impacts are going to be. Because if it's beneficial for the policies we're designing, I want you to be aware of it. And I want to be aware of it. And it's possible that Allianz might be a little bit behind on that. You know, if they're not going to change over till the end of the year. Now, the 7702 changes, what that does is for whole life policies, it changes the guarantees. No longer going to be a 4% guarantee. The highest the guarantee can be is 3.75. The lowest it can be now is 2%. So currently we have 4% guarantees across the board. That's the high and the low. But a lot of insurance companies, it made it a challenge for them. Now, the major carriers that I deal with, Guardian, Mass Mutual, Penn Mutual, they've all paid out dividends higher than 5%. So well over that 4% guarantee. So it doesn't really impact them. Like, they shouldn't have to change their products, but they're going to have to because they're no longer going to be able to offer that 4% guarantee. It'll be 3.75. The new rules will also allow more cash value to be contributed with a lower death benefit. So it's possible that we could get a little bit more cash growth in the policy. Now, I'm not too concerned about those changes because for the most part, we're going with whole life because we actually want those higher guarantees. I don't know that we would necessarily do a whole life policy and be happy with just having a 2% guarantee. Depends. Depends on the carrier you're going with, right? Because there's some carriers out there that they have, their current dividend rates are terrible. They're like 3%. Meanwhile, Guardian, Mass Mutual, Penn Mutual, all up around 6%. So you're going to have to, you as the client, you as the customer, trying to find a product out there that's going to work good for you. You don't necessarily want to just go with whatever the illustration numbers are going to show, because that lower guarantee, if it's a carrier that might be susceptible to paying out lower dividends, that can make a big difference. Can take a hit. So it's something that we'll be paying attention to. I'll definitely share with you guys what I find out. As far as IULs go, the 7702 will probably help in that regard because we'll be able to contribute more for the death benefit. It also instituted some changes with the CVAT, making that a little bit more attractive. Now, the CVAT is a way that we determine the MEC limit. We've got the cash value assessment test, which is the CVAT, and we have the guideline premium test. I design policies with the guideline premium test because it's way more efficient. We don't need as much death benefit throughout the whole life of the policy. And so we end up with much, much higher cash values down the road. With the CVAT, you have to have a higher death benefit throughout the life of the policy. Well, with this new 7702 change, it doesn't require as high of a death benefit. You still have to have a higher death benefit. So I imagine I'm probably still going to keep the guideline premium test designs. But who knows? I'm going to have to check it out. I'm going to as usual, I let the numbers decide. I'm not just going to guess and stick to it because that's what's always worked in the past. That's how I've always designed it. No, we're going to take a look at it. We'll see what the designs tell us, and we'll let the numbers decide. So hopefully that answered your question well. Deep in the money, how you doing? Any general advice for budgeting and or planning for the future? yeah, I do think it's a good idea to at least do a budget at least once. I don't do budgeting in my personal life. I basically just keep it all in my head because it's not too complicated. All the things I got going on, it's actually not that complicated for me to keep track of it. So I don't budget. I don't really budget, but I did do a budget. I did do a budget a while back just to make sure I know where my cash is going. So it's good to do it every once in a while, just so you're not leaking money in places that you don't realize. Oftentimes, it's good to do it because these days, there's so many different things that we just have our credit cards automatically paying for. And so we might have a subscription here, subscription there, and we just start piling up these subscriptions we're not really using. So by going through and doing your budget, it's a good time to start eliminating some of that stuff, figuring out what you can cancel. So that's definitely a good way to start. And you can take the information you get from your budget, you figure out your extra cash flow. Now you're going to use that to start planning for the future. I would recommend checking out my wealth pyramid. I have a video called, might be called the retirement pyramid or the wealth pyramid. I can't remember. But anyways, check that out because when it comes to planning for the future, you want to make sure you have a nice, solid financial base with which to build off of. Okay? When you have a solid financial base, it's going to set you up to where you can withstand a lot of things that get thrown your way throughout life. If you don't, our pyramid consists of a lot of solid financial stuff at the bottom, and then it gets more risky as we go up the pyramid. Oftentimes, people start right at the top. They start off with doing risky investments that might turn up and give you a really big return. But you've got no base, and it's easy to topple it over. So in the case of an emergency, everything falls apart. So that's why I like the pyramid as a visual. We build that solid financial base, and from there we just work our way up. And if you do that, I think you will be pretty successful. It's going to be hard not to be successful. Let's put it that way. Boba, good evening. Good evening. You're welcome, Scott. You're welcome. All right, so we're at 1 hour and 3 minutes, and I'm going to try and cut this short before my voice goes away because I got a movie to go watch. So you guys go watch it too. We'll talk about it later. I'm going to play you out with some music. Thank you for joining me tonight for our Wealth Care Wednesday. I will be back again next week for another Wealth Care Wednesday. I think we've only missed one over the last year. And as usual, I open up the market. I'm doing day trading on Tesla these days as we open the market. And what I'm doing in those videos is I'm showing you my charts and the indicators that I'm using, and I talk about how we read those. So if you have any interest in learning some technical analysis, how to read indicators, if you have any interest in day trading, it might be helpful. I'm not suggesting you copy my plays. God knows that's a recipe for disaster at times. Because oftentimes you might get in just a little bit later, you might get out just a little bit later, and those changes, those delays can make a big difference. But the idea is to just get better educated. Like I spend a lot of my time with and a lot of money in the market. I put a lot of effort into educating myself on that so that I can get better at it. And if you do the same thing, if you spend time in the market, I suggest you do the same thing. You always want to spend time getting better. And that's what we do here too, right? With our Wealth Care Wednesdays. Money is fundamental to everybody's lives. And so it behooves us to understand it and know how it moves so that we can maximize our cash flow and just be more successful financially. Everything gets easier when we do that. And it starts with education. So highly recommend you guys keep watching those videos. Keep asking the questions. You're welcome to leave me voicemail questions at my website, OregonCashflowPro.com. And you're welcome to sign up for a meeting with me at calendly.com/cashflowpro. I just put the link again in the chat. Should be popping up any second. Happy to meet with any of you guys on any subject. I do one-on-one consultations. You can get some free consultations. I offer some paid consultations. We can do education on the market during some of those consultations. Darius, how you doing, my man? How are you doing? Hope things are going well for you. All right. And with that, I'm going to let you guys go. Have a great night. Appreciate you guys being here. And we'll see you next time. Oh, that one. Play you out with some good music.